In this week's extra recording, we're going to look at additional IFRS 3 issues. So in week one, we looked at the basic, what we call acquisition accounting, or another word is called business combinations. So when two businesses combine, or one parent acquires a subsidiary, IFRS 3 comes into play. It tells you how to initially account for that acquisition, how to bring in the assets and liabilities of the subsidiary, and how to deal with the creation of an NCI, the dealing with the investment, how much you paid for it, and ultimately the outcome, either goodwill or a gain from bargain purchase. So it provides all the guidance for initial subsidiary accounting, which is often called business combinations. Right? So we've looked at the basics already in terms of the 5 steps. Right? So we've looked at identifying the date of acquisition, identifying the acquirer, identifying the consideration, valuing the assets and liabilities of the subsidiary, and calculating goodwill, or it could be negative goodwill, known as gain from bargain purchase. What we're going to look at now is additional issues, or if you want, advanced issues, the more complexity. So for example, we're going to look at, well, what happens if you don't pay cash and you pay different types of consideration? So you might pay deferred consideration, where you pay sometime in the future, or you might pay consideration that's contingent on something happening. Or you might pay non-cash, for example, pay shares, a share for share swap. So how are all those accounted for and dealt with under IFRS 3? We look at the second type of method to value the NCI. Method 1 we've looked at is the partial method, its share of net assets. There's also method 2, which is called the full method, where you measure the NCI at its own fair value. We'll then look at what's called a staged or a stepped acquisition, where you take control of a subsidiary over a number of steps. For example, you might have bought 20% 3 years ago, and now you buy another 40%. So actually, only after you buy the second transaction, the 40%, does it become a subsidiary, when you then own 60% in total. So how we deal with that stepped or staged acquisition. We'll look at how to recognize assets and liabilities that weren't previously recognized when you're looking at that fair value of net assets at the acquisition date. There's a couple exceptions to rules that you'd have looked at before, and we'll look at that under IFRS 3. And we'll finish off then with a small bit about deferred tax. You'll have covered that last semester, looking at IAS 12. We'll look at how does that relate to if you acquire a subsidiary, you might inherit then a deferred tax position as well, and how that's accounted for. So really these are added complexities. We still have the same 5 steps. It's still fair value of the consideration you paid for your holding, the value of the NCI, and the value of any previously held interest, adding up 1, 2, and 3. That values the whole 100% of the subsidiary. You then compare that to what the fair value of the subsidiary was in terms of its net assets and its liabilities. And the difference then will either be a positive figure, which will be goodwill, an asset, or it'll be a negative figure, in which case that's a gain from bargain purchase, and that will go to the profit or loss statement. So the same 5 steps, what we're just looking now is at complexities that arise or advanced issues at a master's level. The first thing we're going to look at then is the different types of consideration that can be paid. Cash is the most straightforward one, where a parent acquires a holding in a subsidiary. It'll be debit investment, credit bank. Nothing more complicated than that. But in realistic terms, in the real world, you can have a share for share exchange. So when Facebook bought WhatsApp, most of the consideration that they paid was in the form of Facebook shares. So WhatsApp's current existing shareholders swapped their shares in WhatsApp for shares in Facebook. Very limited cash changed hands. And you'll deal with that in Cap 2 tax as well, or in the master's level tax, dealing with share for share exchange and share for share reliefs as well. You can transfer assets, so swapping assets as part of the consideration, or take on liabilities from the former owners as part of consideration. You might look at contingent consideration, where a future payment as part of the deal is contingent on something happening. You'll often see that in football deals. You might get a contingent consideration where a football player is transferred and there might be an extra 5 million if he plays 12 matches in the Premiership, or if he wins the Champions League, another 5 million is paid. That's called contingent consideration. Right? It's not guaranteed, it's contingent on something happening. And you can often have those in business where there might be extra money to be paid if a certain profit target is hit. And finally, then you have deferred consideration. This is consideration that will be paid. It's not contingent on anything, but it's going to be deferred for a period or two, maybe a year or two down the line. So you're spreading out the amount that you're going to pay over a number of periods. So the key thing for us for accounting is we have to do the goodwill calculation at a particular date, i.e. the date of acquisition. If it's cash, that's easy to value. We know how much cash you've paid. But for the other ones, we need core rules around how we get the fair value of those at the date of acquisition, because we need to put those in as the consideration for the goodwill calculation. So for shares, they're going to be measured at their market value. Cash is measured at the actual amount of cash, that's straightforward. Deferred consideration, that's measured at its present value. So you need to take account of time value of money. So if you're not paying that money for 2 or 3 years, you get the present value of it today. And we'll look at examples of each of those. And finally then, for contingent consideration, you need to get its fair value today, because you're looking at the likelihood that that's going to be paid and how far out it's going to be paid for, i.e. looking at time and the probability that it will occur. So there's a bit more complexities now than just having a cash deal where you buy a percentage ownership of a subsidiary. And this is why we're looking at advanced IFRS 3. One other important rule in IFRS 3 is any costs related to the acquisition, so legal advice, solicitor's fees, accounting fees, they should be expensed to the P&L and not capitalized. So if you see transaction fees as part of the investment on a parent's statement of financial position, that should be a red flag. You know that's not allowed. It should be debit the P&L, expense, not debit the investment. So you're not allowed capitalize and create an asset for transaction expenses. And that is the rule under IFRS 3. So watch for that in exam questions. It's quite a popular topic to come up. So the first one then let's look at is a share for share exchange. Right? So on the 1st of October, Blues, who's the parent, acquired 60 million shares in Soul in exchange for 75 million of its own shares. So be careful what's going on here now. Blues is the parent, and what they're going to do is they're going to issue 75 million new shares. In return, they're going to get a 60% shareholding, 60 million over 100 in Soul. So it's a share for share exchange. Now you'll deal with this in mergers and acquisitions in corporate finance, but one of the big benefits for Blues of doing a share for share exchange is it doesn't have to raise the finance, because all it's doing is doing a paper transaction, swapping one set of shares to the other. Now there is a dilution of control, because now the existing Soul shareholders are going to become Blues shareholders. So the existing Blues shareholders have diluted. They have less control than they had before. But the benefit is you don't have to raise the money. For Soul's perspective, they don't get any cash, but they are continuing to involve in the bigger business. Right? And the other big benefit for Soul, who is the target, is you most likely won't have a capital gains tax event. It won't crystallize a tax gain, because if you're doing a share for share swap, you can postpone the tax event until those subsequent shares are sold. So there is a relief there for share exchange, and you'll probably cover that in your master's tax module as well. The market value of Blues shares at the date of exchange was 260. So think about that now. What's the value that you paid for the 60% holding? It is 75 million times 260. And be careful, you're issuing 75 million of your own shares at 260. The 60 million shares are not valued at 260. It's the new shares that are issued. So you're valuing then that 60% holding at 195 million, issuing 75 million new shares at 260 each. Right, that's the first key thing to watch. So what would the entry be then in the parent's accounts? Well, the parent is making an investment of 195. So it's debit investment. This isn't the parent in Blues accounts. Instead of the normal credit bank, which you would have if it was a cash transaction, you're now going to credit share capital, the nominal amount, which is 75 million, 75 million shares at €1 each, and the difference, which is 120 million, will be credit share premium. So that will be in Blues accounts. So if you're doing a statement of changes in equity, that will be in there, because that's a movement in share capital and share premium. Now, please be careful and write this down. This is in the parent's accounts, not in the subsidiaries. It's the parent that's issuing new shares to buy a particular investment, a 60% holding in Soul. Right, that's very important that you understand that. And then you use that 195 million investment to calculate goodwill, like you would have done in any other question. So if you go back, you're buying 60%, the date of acquisition, the net assets of sold are 190, and that means we can value the NCI as well. Because if the Blues acquired 60 million, 60%, the NCI will be worth 40%. So you can do your full goodwill calculation as normal. Even though you're not paying cash, it doesn't matter because you still have an investment you paid in the form of shares. So your goodwill calculation is the exact same as before once you have the initial investment accounting completed. Your investment, which is from the parent, plus the NCI, which is the net assets at the acquisition date, times the NCI share. We call that method 1. And you take that from the fair value net assets. So the goodwill there is 81. You get rid of the equity, which is debit share capital and debit retained earnings, 190 respectively. We have just shown that as a single figure, but that would actually be debit share capital and debit retained earnings. You create the goodwill for the first time, 81. You create the NCI for the first time, 76, and you remove the investment as that's no longer needed. What you've done instead is you've brought in the net assets of the subsidiary. So once you initially account in the parent's accounts under IAS 27 for the share for share exchange, everything after that is as normal. Goodwill calculation is as normal. Use the investment figure that's given in the question. Right, so there's a lot of overlap here. It's just one or two advanced areas you need to watch for. And you can, of course, in an exam question, get a combination of consideration. Part of it in cash, part of it in shares. So watch out for that as well. So the next alternative then is where, for example, you swap assets or take on liabilities. So instead of, for example, paying cash or shares, you might say, oh, I will give you this particular property or I'll give you some inventory as part of the consideration. If that's the case, it's debit investment and credit assets. Now, just be careful if that was actually in the real world, what you may have, for example, if you swapped a property and said, I will give you this property as consideration for an 80% holding in the subsidiary, you may have a profit or loss and disposal of the property. Depending on what market value you attach to that property in the deal, you may have to recognize a gain or loss and disposal. Now, we don't go into that too much here, but it's just to realize that when you're de-recognizing one asset, you may have a profit or loss, particularly if it's a property, plant and equipment. The alternative way is you might take on liabilities from the owners. So you might say to the owners of a potential target, I will take on that loan that you have as part of consideration. So you're not giving them an asset, you're taking over one of their liabilities. It's a still consideration. So you're increasing your own liabilities, and what you're getting in return is an investment in a particular subsidiary. So this is non-cash consideration where you're swapping assets, or what you're saying where you're assuming liabilities from the owners of a potential target. Both are very similar. You increase the asset, the investment should I say, and you either decrease your assets if you've swapped an asset out, or increase your liabilities if you've assumed liabilities, such as debt, on behalf of the former owners. The other two main ones we wanted to focus on is, and we'll give you an example here first of the liabilities of a type of debt. For example here, 1st of January 2009, Kyle acquired 10 million shares in Goddard and obtained control. Each share was bought for €2 cash. In addition to the purchase consideration, consisted of a 10 million loan repayable by Kyle. Now this is often called vendor finance. Essentially what's happening here is the vendor, the seller, i.e. the owners of the subsidiary, are giving a loan to the buyers because they're willing to delay receiving some of the consideration for, in this case, 8 years. But that still forms part of the consideration. So when you're looking at how much you paid for the 10 million, you're saying it's 10 million shares at €2 each, which is paying cash 20 million, credit cash or credit bank, and you're also taking on a loan. So you now have a loan that's payable to Kyle, credit loan 10. So all in all, you have an investment of 30 million. And it's that 30 million that you will be using to calculate the goodwill on the acquisition of Goddard PLC. right? So that watch for that. In Kyle's accounts, they are the parent, they are the acquirer. They've made an investment of 30. Part financed through bank or cash, paying €2 per share. Part financed through a loan. And this loan is not actually from a bank, it's from the vendor. Right? Right? The purchase consideration loan repayable by Kyle. So it's a vendor finance. The vendor, i.e. the seller, is helping the transaction to go through. Deferred consideration is similar to cash in that you agree to pay a certain cash amount, not today, sometime in the future. Right? So often acquirers will try and do this to stagger out the amount of paying. So you don't have to finance all the consideration today. You'll smooth it out over a number of years to make it more affordable and not to deteriorate your liquidity too much. So for example, a payment of 1 million at the date of acquisition, which we call a cash payment, and then payments of $250,000 for each of the following 4 years. So you have two separate things going on. The 1 million today, that's valued at 1 million. Debit investment, credit bank $1 million. The following 4 payments at the end of each of years 1 to 4 respectively, has to be present valued. You can't just value another $1 million for that because you have to account for the time value of money. And when you're doing that, you need to account for the present value today because that's the amount that's going to be included in your goodwill calculation. Right? So it's important to be careful there. Is the cash payment upfront, in which case it's quite straightforward, or is it going to be over a period of time? And that one that's over 4 years, that's going to be recognized at its present value. So hopefully you remember your basic time value of money from your undergrad. That's actually an annuity. It's a 4-year annuity that you can get the present value on. So what we will do here, for example, is we'll debit the investment just for argument's sake. Say it's the 1 million cash, and we'll say that happens to be 600. So say 1.6 million. Now I haven't done it exactly because we need the discount rate, but we'll say for argument's sake, you credit the bank 1 million and you credit deferred consideration 0.6 million. So we're saying even though you're going to be paying 1 million over 4 years, the present value of that is 600,000 today. Now we need to know the discount rate to actually get an accurate one. I'm just showing you in practice how it will work. So the investment that goes to the goodwill calculation today is made up of any cash amount at its full value, because that's at its present value already, plus any present value of any deferred consideration. What you will do then in the intervening years, the next 4 years, is you will have to recognize the time value of money. Because as you get closer to the payment dates, this present value gets bigger. So we call this, and you will have come across this in IAS 37, where you unwind a provision that had time value of money considerations here. Is the subsequent recognition is you unwind the discount for time value of money as the years go on. And there's a number of 4 questions in your pack that deal with that. So that's something to watch for. It's not just about initial accounting at the acquisition date. You have to consider that at the end of year 1 into year 2, you're going to be paying off the 250,000. So your time value of money moves away because you get close to the payment date, and you recognize that through a finance cost in the P&L. Now, I know appreciate that's a bit wordy there, so we're going to look at a practical example to see how this works, so we understand it. So take this example here, where P Limited, the parent, acquired 3/4 of a subsidiary on the 1st of January 2014. They made an immediate cash payment of 500 grand. That's easy enough. Debit investment, should I say, credit bank. This is an outflow. Your investment in a subsidiary in the parent's accounts. And a further 200,000 1 year later in 15 and 2 years later in 16. So overall, ignoring time value of money, the investment is 900,000. 500 today, 200 in 2 years and 200 in 3. 200 in 1 year and 200 in 2 years. However, IFRS 3 says you can't look at it like that. You have to account for the time value of money. Now we know how to get the present value. You can use your discount tables. And because it's going to be an open book exam, you should have your tables with you in case you need them. So for example, at the date of acquisition, when we need the present value, on the 1st of January 14, 200,000 payable in 1 year will be multiplied by 0.909. which is 181,800. So the present value of that first payment is 181,800. So you will debit investment and you will credit deferred consideration. That will be a liability in the statement of financial position because it's going to be paid soon. The other 200,000 is going to be multiplied by 0.8294, the discount factor for 2 years at 10%. That is 165,880. So you debit the investment again with that. So you have 3 items in the investment now, and you'll credit deferred consideration as well. So that's what they've done here. They've valued the total investment of cash, present value of 1 year, present value of 2 years. The cash comes out of bank, credit bank, and the rest of them are called credit deferred consideration, which is a liability. So that is at the date of acquisition. So when you're doing your goodwill calculation, you're going to be valuing the investment in the subsidiary at 847,680, and that will calculate your goodwill. However, think about what happens now at the end of 2014, the subsequent accounting, once we have the acquisition complete. Well, now we're 1 year closer to the payment of this 200,000 in 15, a day later, and in a 16. So you have to revalue these present values. So the payment in year 1 at the end of 2014, its now present value is 200,000 because it's going to be paid at the start of 2015. There's 1 day in the difference that's immaterial. So the payment in year 1 now is going to be, the deferred consideration is going from 181 up to 200,000. You compare because it's now at its present value. The payment on the 1st of January 16 is now 1 year away. So it's now valued at 181. So you revalue the deferred consideration at the end of each year because you're closer to making the payments. So the present value have gone up. So where it was initially recognized at the start of January at 347, the deferred consideration now should be recognized at 381 because you're getting closer to the payment dates. And that means you're unwinding the time value of money discount. And how you unwind that is you recognize a finance cost of 34,120 and you increase your deferred consideration. Deferred consideration now is going from 347 up by 34120. So at the end of 2014, just before you make the first deferred payment, your closing deferred liability is 381,800. So watch for that when you're dealing with deferred consideration. I've given you 4 full questions in the pack. There's the initial accounting, which impacts goodwill. After that, then every period, you have to revalue the deferred consideration as it gets closer to the payment date and you're unwinding that time value of money discount. That's debit the finance cost, which is in the P&L, and credit your deferred consideration, which is a liability. Right, so a lot of students do struggle with that. It's important you go back and practice and make sure you're happy, number 1, with the calculations, and then number 2, with the debits and credits. The other last one we want to look at this part of the recording is contingent consideration. So contingent consideration is going to be in the future, but it's not certain. So unlike deferred consideration where you know it's in the future, but you just have to account for the present value, there's no risk involved. In this one, it's contingent on something happening. Now, this is quite common in M&A, which is called an earn-out clause. So for example, one company buys a shareholding in another company, and they say, we will give you extra consideration if we meet certain profit targets over the next 2 or 3 years. So it's kind of, you can earn out a particular extra money. And usually the reason that's done is the buyers want to keep the management team in situ. So if you're buying a new company, you don't want to lose all the management up front. So to incentivize the management to stay on for that transition period, maybe if you're a year or 2, you say, we will give you, for example, an extra 5 million if you stay on for 2 years and you hit certain profit targets. So you're keeping that transition, you're keeping the management team there to keep everyone happy, you're allowing a smooth transition, and you're also incentivizing them to perform well by saying you can qualify for extra money if you earn certain targets. So this consideration is not guaranteed, but it is a possibility. So it's contingent on something happening. So how we account for that then is you're going to have to get an expert to get its fair value at the acquisition date. So at the date of the acquisition, you look at the deal, you look at the conditions of the earn-out clause or whatever contingent consideration is, and you see how likely it is to have to be paid. And you get that fair value and you debit the investment and you credit contingent consideration. If it's in the form of cash, contingent consideration, it'll be a liability. If it's in the form of potential shares in the future, it will be equity. So that distinction between a cash settled contingent consideration and an equity settled is important in terms of how to account for it. So that's the initial accounting treatment at the acquisition date. And that figure then, this investment figure, will be going to the goodwill calculation along with any other consideration in the deal. Right? Now remember, you'll be given what the fair value is. You won't be expected to calculate it. However, you have to also think about subsequent accounting treatment. That after the date of acquisition and at the end of every period, you have to look at the changes in the fair value. So as it gets closer to the deadline for contingent consideration, time value of money must be unwound. But also it might be more or less likely that the deal is going to, that the threshold is going to be met, or the profit targets or whatever target is going to be met. So at the end of each period, you will be told what the updated fair value is. Right? So the subsequent accounting treatment will depend on whether the potential consideration or additional consideration is in cash or shares. If it's in shares, you don't remeasure. Right? So you never remeasure at the end of each period. You only account for it at the very final settlement, if they qualify for the deal or not. That's similar enough to what you do in IFRS 2, where you don't remeasure share-based payments if they're equity settled. However, if they are cash settled, you must remeasure the fair value at the end of each period. So if the fair value goes up or down, you will debit or credit the P&L for the loss or the gain, and you will debit or credit your liabilities for the loss or the gain. Similar in concept to cash settled share-based payments in IFRS 2. So remember, cash settled share-based payments, for example, share appreciation rights, or short for SARs, they are remeasured at the end of each period. Now remember, these remeasurements don't impact goodwill. Goodwill is only impacted by the initial accounting, and then that's complete. After that, the only thing that this is going to impact is your P&L and your value of your contingent consideration. And what you've just be careful of is this contingent consideration in the form of shares or in the form of cash, because the treatment of it and the presentation of it is different. So again, let's look at an example to hammer home this. So here P acquired S Limited. The consideration was in two stages. 1 million cash payable at the date of acquisition. Straightforward enough. Debit investment, credit bank. A further $500,000 after 2 years, so a cash payment, if the profit after tax for the 2 years exceeded 2.2 million. And they told you at the date of acquisition, the fair value of this payment was assessed to be 0.1 million. So even though the payment could be $500,000, because it's 2 years out, there's time value of money, and also because it may not be guaranteed, you're going to reduce the fair value of it because there's chances that it won't actually be received. It's not guaranteed. So at the date of acquisition, the fair value of the investment will be 1 million cash and 100,000 contingent consideration. So in your P limited accounts, you have an investment of 1.1 million, which you will then use to calculate your goodwill. You'll credit bank or cash 1 million, and you'll credit liabilities, which will be called contingent consideration. And that will be at that date a non-current liability because it's over 2 years away before this thing will be settled. So it's about presentation as a liability and whether it's current or non-current then. So that's the date of acquisition. Roll forward then 12 months. At the end of each reporting period, because this payment is in cash, you need to remeasure it. So at the end of the year one, the contingent consideration is more likely now, so its fair value now is $250,000, 0.25. So all you do simply here, so it's a bit easier than the deferred consideration, you fair value, you remeasure the contingent consideration. You increase your liability from 100,000, 0.1 million, up to 0.25. So you only recognize the difference because the 0.1 million is already there. So you increase it by 0.15 million, and that is going to be here, debit the SOPL. you put that in as a finance cost, debit the SOPL. Right? So again, if that was, for example, if that would fall into 0.05 million, then you'd be crediting the P&L and you'd be debiting the liabilities. So it can go up or down, but that's only when the payment is in cash. You do not remeasure it if the payment is in shares. So you can see the exact same example here. P acquired S, 2 stages, except it's the contingent consideration now is new shares, the exact same target. So the fair value happens to be the same. So that means the initial investment is the same. But look at where it's presented. It's called contingent consideration. It's presented as part of equity because it's not a liability. Same that you do with a share option reserve if you're doing IFRS 2. You would not show it as a liability if it's an equity settled share-based payment. In a year's time then, even if the fair value contingent consideration is moving, you do not remeasure it. That's the rule under IFRS 3. It is the only time it will be remeasured again is if the contingent consideration has to be paid and new shares are issued. And that will be dealt with in other questions you'll see in the question pack. So there's two things with contingent consideration. The initial accounting for it at the date of acquisition, i.e. at its fair value. And that's the figure that's going to impact your goodwill calculation. For every period after that, you'll recognize the movement in the fair value if it is cash settled. If it is equity settled, you leave it. You don't do any accounting entries, but you explain in an exam question why you're doing that and which particular standard is requiring you to do that. Right? So that just gives you a summary of the date of acquisition and the subsequent accounting. And I've also given you a nice question, question 4, in that question pack 2, which is going to go through that example from start to finish to show you exactly how contingent consideration works initially and also how you deal with it in subsequent accounting as well. So there's a nice example of this of the acquisition you'll see here in terms of CRH. If you look at the 2018 annual report, which is the one that's given in Loop, and we're looking there at page 194. So you can see here the business acquisitions, and it tells you all the identifiable net assets. So you can see here when you're acquiring them, it says the assets acquired, the liabilities acquired, and what you can see here is the consideration. Most of it was paid in cash. See it here? 2961. Majority is paid in cash, but you have some asset exchange where they swap some assets. You have some deferred consideration, which is stated at the net cost. That's what we've been doing. You have some contingent consideration, and you have a profit on a stepped acquisition. So we haven't dealt with that yet. That's your stepped acquisition, your staged acquisition. But even look, contingent consideration, note 3, see what it says? The fair value contingent consideration is 93 million, is arrived at through discounting the expected payments. So they do scenario modeling to see, well, what is the best outcome in this contingent consideration? Are we going to meet the relevant targets? Right? And on an undiscounted basis, the future payments may be liable to range from 136 to 206. So what they're saying is if all of these targets are met, we might have to pay between 136 and 206 extra million in consideration. Because remember, they're paying this money as contingent consideration. The fair value of that today, taking account of the likelihood it's going to be paid and taking account of time value of money, is 93. Right? And that's what they've included here, the contingent consideration. So you see what you're calculating here, what you're doing, this happens in the real world as well. Right? So that's important that you get an idea of where these figures are coming from. That's a good example there in terms of they had one material transaction, Ashgrove, that's why it's disclosed separately, and all the other acquisitions, they're not material themselves, so they're only aggregated together and they're shown the total figures. Right? That example there is from CRH, the annual report, which is available on Loop. So that's the end of this first recording. In the next recording, then we're going to look at the rest of the advanced IFRS 3 issues. NCI, previously held interest, and the fair value of assets and liabilities.